Oh my God, Walgreens dropped over 9% today. Let's find out why. Welcome to my channel. I'm Scott, and in this video, I'm going to walk you through the process of valuing Walgreens stock so we can determine if it's a buy or a sell. This company is the second largest pharmacy store chain in the US. The largest is CVS. And they were founded 122 years ago in 1901. Let's get started with the model. This is a large cap company, 25 billion market cap. They're trading at $29 a share, and they have 862 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow doesn't look so good. It goes from 4.1 billion to below 1 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's all over the place. Low in 2020, over 4 billion in 2022, negative in the trailing 12 months. That's from write-downs, lots of asset impairments. Revenue is a sales for the company, and that's been declining from 139 billion to 133 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 42 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $36 billion. We divide that by 862 million shares. And we get a calculated stock price of $42. They're trading at $29, so they're trading at a 32% discount. It's a pretty strong buy according to the model. There are 11 companies in the same industry as Walgreens, and if Walgreens has a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot in CapEx, $2 billion, which is more than the other 10 companies combined. These are investments in property, plant, and equipment. So I think a lot of their CapEx is the stores, the real estate they purchase. They have a pretty weak debt to equity ratio. For every dollar of equity, they have $1.80 of debt. They do pay a nice dividend, over 6%. PetMed Express is 6.5%, and the other companies don't pay a dividend. They do generate a lot of free cash flow, and they're by far the largest company on this list. You could sum up the other 10 companies' market caps and multiply by 10, and you're still below Walgreens. Their price to book is a lot better than the average, worse than the median. Price to book is market cap over equity, or stock price over book value per share. This implies an investor is paying $1.30 for $1 book value. Their PE is exactly at the median, 6.1. because there's only 3 companies that have a PE on this list. Leafly has an amazing PE. PetMed Express is 1,300. So of course Walgreens is the middle, the median. Their price to free cash flow is a lot better than the industry average, a median. This is stock price over free cash flow per share. Really good price to sales, 0.3. That means their market cap is 1/3 of their revenue, or their revenue is triple their market cap. This is pretty common with companies like this or supermarkets. They have really low margin. So they bring in lots of revenue, but they're not that profitable. Like a tech company might have margins of 20-30%. When I say margins, I mean net profit margin, net income over revenue. Where a company like this may have margins of 1, 2, maybe 3%. They're not really growing anymore. Their 5-year annual revenue growth rate is only 1%, which is a reason the stock has been selling off and the price has been coming down a lot over the years. As you probably know, the stock dropped a lot today. It's down over 9%. Let's go through their press release to figure out why. They did release their third quarter results. Their third quarter of 2023 ends May 31st, and their fiscal year ends August 31st. A big reason the stock went down is because they revised their guidance. They lowered their forecast for the year. And the reason they cited was lower COVID-19 demand. They are taking immediate actions to improve profitability, and they're doing that by cutting expenses $600 million. Their third quarter EPS was 14 cents, down from 20 cents a year ago. Adjusted EPS increased 3.3% to $1, up 3.6%. They booked $1.9 billion in proceeds from AmerisourceBergen. Also part of the $1.9 billion is a sale of the shares of Option Care Health in the third quarter and also in June. They're accelerating the acquisition of CareCentrix, which cost them $380 million. The two main reasons stocks increase a lot or decrease a lot is the company's earnings, the earnings from the prior quarter, or their guidance in the future. That's why the stock declined so much today, is because of guidance. They're revising their full year EPS guidance to $4 from $4.45 to reflect consumer and category conditions, lower COVID-19 contribution, and a more cautious macroeconomic forward view. Their transformational cost management program target went from $3.5 billion to $4.1 billion. That's just a really fancy way of saying we're cutting expenses. So they're looking to cut $600 million more of expenses to try to hit their profit goals. That's just a nice way of saying there's going to be lots of layoffs. Here's an overview of the third quarter. Sales increased 8.6% to $35 billion, reflecting sales growth in U.S. retail pharmacy and international segments, and a significant contribution from the U.S. healthcare segment. Operating loss was $500 million in the third quarter compared to $300 million last year. Operating loss in the quarter reflects a $431 million non-cash impairment of pharmacy license intangible assets, which is in their Boots UK division. That just means they overpaid for licenses in the past and now they're writing them down. This is a non-cash item, so it doesn't affect cash flow. That's why they still pay a really nice dividend. Net earnings in the third quarter was $118 million compared to $289 million last year. Adjusted net earnings, $860 million, up 3.4%. EPS 14 cents compared to 33 cents last year. Net cash used for operating activities was $20 million in the third quarter. Free cash flow negative $444 million, a $1.7 billion decrease compared with a year ago. That's from the phasing out of working capital and increased CapEx, including growth initiatives and U.S. healthcare. $104 billion of sales for the first 9 months of 2023, an increase of 3.4%. Inflation now is probably like 5-6%, so they're actually doing worse. If a company grows 3, 4, 5%, that pretty much means they are flat from last year. You have to grow at least above inflation. If you're growing 10%, then you are truly growing. If you grow 1% in a year, you're actually declining because of inflation. And this year, inflation is so high, so you have to grow a lot more than the traditional 3 or 4% just to keep up with inflation. Here are some of the big wins for the quarter. They have a scalable partnership with Telepharm, part of Cardinal Health's Outcomes business. Cardinal Health is a huge company, ticker CAH, check them out, enabling a telepharmacy to expand access and reach more patients in local communities. U.S. pharmacy comparable script volume growth of 2.8%, excluding immunizations. They addressed industry-wide pharmacist labor shortage by returning an incremental 300 stores to normal pharmacy operating hours and optimizing hours at an additional 500 stores. U.S. retail comparable sales declined 0.2%, including a 40 basis point headwind from tobacco and an 80 basis point headwind from lower levels of OTC test kits, over-the-counter test kits. Operating 9 automated micro-fulfillment centers at quarter end, supporting 3,900 stores. Boots UK retail comparable sales growth of 13.4%, on top of robust prior year growth of 24%. They launched the world's first super peptide skincare range. On launch day, one product was sold in the UK every 2 seconds. 500,000 transactions in the first 4 weeks. They launched this program in the US this month. The US retail pharmacy segment had third quarter sales of $28 billion, an increase of 4.4%. So they're down about 1 or 2% if you build in inflation. The international segment had third quarter sales of $5.6 billion, an increase of 5% from last year. The U.S. healthcare segment had third quarter sales of $2 billion, an increase of $1.4 billion compared to last year. Fiscal 2023 outlook and preliminary fiscal 2024 commentary. So for 2023, adjusted EPS of $4 to $4.05, down from $4.45 to $4.65. That's from a major decline in COVID-19 vaccine and testing volumes. So they're not going to provide 2024 guidance, They will next quarter when they report their fourth quarter and full year 2023 results. Walgreens is an integrated healthcare pharmacy and retail leader serving millions of customers and patients every day with a 170-year heritage of caring for communities. They have 13,000 locations in the US, Europe, and Latin America. They employ more than 325,000 people, and they have a presence in 9 countries. When you look at all their businesses, which is Walgreens, Boots, that's the UK pharmacy, Dwayne Reed, that's popular in Manhattan, the No. 7 beauty company, Benavides in Mexico, Ahumada in Chile, plus they also have a presence in China. Let's look at the numbers. The words confuse me. Numbers make sense to me. For the 3 months ending 5/31/2023, sales of $35 billion. Last year, $32.6 billion. They didn't release their 10Q yet. They probably will release it in a few days. But usually when I look at the 10Q, I provide more backup on all the numbers. Like for instance, I want to know what makes up the $35 billion. How much is their revenue in each country? How much is their revenue by segment? That's all in the 10Q. In order to generate the $35 billion of revenue, it cost them $28.8 billion. That includes the rent for its pharmacies, the payroll for its staff, the cost of the products they buy. Like for instance, if they buy soap for $1, that's in cost of sales. And if they sell that soap for $2, the revenue is in sales. Revenue minus cost of revenue gives you your gross profit, $6.6 billion. But their revenue is a lot higher than last year. It's about 10% higher. Their margins are getting squeezed because expenses have gone up so much. You have to pay employees more than before. Supplies are more expensive. Everything's more expensive. Then you have selling, general, and administrative expenses. If you ever see those TV commercials, the cost of those commercials is in SG&A. Also, the payroll for the person in marketing who developed that commercial, that's also in SG&A. So they have an operating loss of $477 million. They paid $173 million of interest on their debt, 70% higher than last year of $108 million. They have a tax benefit of $330 million, so they have a net gain of $118 million, down from last year of $289 million. But in the first 9 months of the year, they have a net loss of $2.9 billion. In the second quarter of 2023, their second quarter, they had a big loss on the income statement. That's why they have a loss in the first 9 months of the year. Last year, they had 864 million shares outstanding. Now they have 863.1 million. So they reduced their shares outstanding 900,000. Let's look at the balance sheet. Only 870 million of cash, 5.8 billion of accounts receivables. This is how much money other companies owe them. This means they sold $5.8 billion but didn't receive payment. They will receive payment in the future. They have $8 billion of inventory. They're always carrying a lot of inventory. And other $1.6 billion. So total current assets, $16.5 billion. Current liabilities, $26 billion. So their current ratio is well below 1. That's a big red flag. You don't want to see that. You can see they have a lot of goodwill, $28 billion. Goodwill is the premium you pay when you acquire another company. That's why they tend to have lots of write-downs from writing down goodwill and other intangibles. So total assets, $99 billion. They have $12 billion of accounts payable. This is how much money they owe companies for borrowing on credit. It's like the opposite of accounts receivables. They have $8.8 billion of long-term debt, $3 billion of short-term debt, so about $12 billion of debt. Then they have operating lease obligations. A lot of the stores are leased. They have total liabilities of $68 billion, $26 billion, and $42 billion. Equity of $29 billion. This is the value of the company, their net worth. So liabilities plus equity is $98 billion, which equals the assets of $98 billion. Here's the statement of cash flows for the first 9 months of the year. To calculate operating cash flow, you start with your net loss, that was $3.3 billion. Then you add or subtract the non-cash items on the income statement. Then you adjust for changes in working capital. So they only generated $1.2 billion of cash for the first 9 months. Last year, for the first 9 months, they generated $3.8 billion of cash. So maybe things aren't going as well as I thought for WBA. In their investing section, they had a cash outflow of $3.2 billion. They spent $1.6 billion in PP&E, property, plant, and equipment. They spent $7 billion in business acquisitions. In their financing section, they had a cash inflow of $600 million. They received $5.2 billion of debt. They paid $5.2 billion of debt. When debt is due, most companies take on new debt to pay down the old debt, which works out well if you get a lower interest rate on the new debt. But I have a feeling they're paying a higher interest rate because rates are going up. They paid $1.2 billion of dividends in the first 9 months, which equals their operating cash flow. So it looks like they're running at a break even. Last year they had $3.8 billion of operating cash flow, and they also paid $1.2 billion of dividends. Their sales in U.S. pharmacies for the most recent quarter is $27.9 billion, international $5.6 billion, U.S. healthcare $2 billion. So that's how they get to $35.4 billion of revenue. And for gross profit, $5.3 billion in U.S. retail pharmacies, $1.2 billion international, and only $89 million in U.S. healthcare. For operating income, U.S. pharmacy is positive $400 million, international they have a loss of $300 million, U.S. healthcare a loss of $500 million. For adjusted operating income, U.S. pharmacy it's nearly $1 billion, international $200 million, and U.S. healthcare still has a loss of $172 million. So their adjusted operating income is $959 million. That's just for the quarter ending 5/31/2023. So you can see their margins are higher in international, 21%, U.S. pharmacy 19%. But for SG&A, they spend a lot in international. 26.5% of their revenue in international is SG&A expense. That's 18% in U.S. retail pharmacy. U.S. healthcare is a whopping 31%. U.S. healthcare is really dragging them down. Let's go through their presentation slides for the third quarter of 2023. Here's the cornerstone of their healthcare portfolio. Village MD, best-in-class value-based primary care. Team-based approach to healthcare delivery. Ambulatory care pharmacist programs. CareCentrix, outcomes-driven post-acute care. Shields Health Solutions, next generation of specialty pharmacy. They're in a process of converting their Walgreens locations to Shields partner sites. Medical billing solutions with Alliance RX. And then Walgreens Health, enabling population health. Expanding existing services and new service lines. Walgreens infrastructure allows for low incremental overhead to support sales growth. Clinical trials recruitment. Trial execution leveraging pharmacy capabilities. Third quarter sales $27.9 billion, up 4%. Year-to-date 2023, $82.6 billion, up 0.3%. $5.4 billion of adjusted gross profit, down 3.2%. Year-to-date 2023, $17 billion, down 7%. SG&A as a percent of sales, 16%. Year-to-date is 17%. Operating income, $960 million. Year-to-date, $3.1 billion. Pharmacy sales up 6%. Year-to-date, 0.7%. Prescriptions up 0.3%. Year-to-date, down 0.4%. They have 2.9 million organic customers, 4 organic partners, and these two numbers exclude Village MD, CareCentrix, and Shields. For Village MD, they have 850,000 customers. Their Village MD sales, $1.5 billion, Shields, $115 million, and CareCentrix, $359 million. All up double digits from the prior year. Operating cash flow, $1.2 billion. They had CapEx of $1.6 billion. They received $530 million from acquisition-related payments, so free cash flow of $116 million. You can see companies do lots of funny accounting. They do all these adjustments to make the numbers look better. They mentioned in October 2022 their adjusted EPS will be $4.45 to $4.65, and they just revised down to $4 to $4.05. In October 2022, they said growth would be between negative 8% and negative 12%. Now they say growth will be negative 20%. The more I'm learning about WBA, the less interested I am in investing in them. They initially said revenue will be $130 to $134 billion for fiscal year 2023. They're revising revenue up to $137 billion to $139 billion. Even though they expect higher sales, they expect lower adjusted operating income. It was $4.7 to $4.9 billion. Now it's $3.9 to $4.1 billion. AOI reflects consumer and COVID-19 headwinds, U.S. healthcare below expectations. They're revising sales up in every category, but AOI down a lot in U.S. retail pharmacy from $4.5 billion to $3.8 billion. U.S. healthcare they had negative 340 million to negative 575 million. But for international adjusted operating income, they're revising up from 850 million to 910 million. And the comments are strong execution across all international markets led by Boots UK, and also a favorable foreign exchange outlook. And their interest expenses going up as well from 500 million to 590 million. That's from higher debt levels related to Summit Health and higher average interest rates. Since they're scaling their Village MD model, they expect lower Medicare Advantage Medicare loss ratio. You can see in Arizona, Georgia, and Houston, they expect the loss to decline. In 2021 in Arizona, it was 88%. The expected loss this year is 72%. Although cutting expenses is one way to increase profits, you could only cut expenses so much, because at some point you can't cut expenses. Revenue is infinite, it could go up forever. Expenses can't be cut below zero. They expect to cut 600 million of expenses this year and 800 million next year. As long as they could still provide the same quality service, it's okay to cut expenses. But you don't want to sacrifice your service for saving money, because then you'll lose customers. Let's look at WBA on Simply Wall Street. Trading at $31.59 a share, 27 billion market cap, down 25% in the past year. One of the risks they mention is their dividend of 6% is not well covered by earnings or cash flows. If they cut their dividend, the stock will crash even more. The stock reached a maximum price of $96, and that was back in 2015. That was the peak for the company. But you can see since 2015, the stock has suffered. In 2018, it had a big run up from 64 to about 85. But since 2018, the stock has pretty much only gone down. At the end of 2020, it was $34, and then it ran up to about 56. But this looks like a good point to get in. For a long-term investment, I think it should be fine. Here's some news and updates. An unknown buyer acquired 6% of Option Care Health from WBA. So somebody bought $330 million of stock from Walgreen's Boots, and they're going to use the proceeds to pay down debt and also support their strategic priorities. I wonder who that person was. Let me know in the comments if you know. Back in April, the CEO bought $340,000 of stock. On June 6th, Walgreens to report Q3 results on June 27th, which is today. But if you're watching this video, it was yesterday. Their second quarter, which was last quarter, EPS and revenues exceed analyst expectations. Simply Wall Street's valuation is $77. They say the stock is 59% undervalued. 15 analysts priced this stock and the average price target is 39. They say the stock is 25% undervalued. Their trailing 12-month revenue in 2012 was $71 billion. Then by 2019, 7 years later, it doubled to $136 billion. But that was its highest point. It's either at this level or lower since 2019. A company really needs revenue to increase about 10% a year to stay viable. Because if they don't do that, they're going to continue losing market share. Their trailing 12-month operating cash flow in 2012 was $4.4 billion. It was up to $8.3 billion in 2018, but it's really been struggling over the years. Now it's below $3 billion. Their interest coverage ratio is 3.1, so they can cover their interest payments 3 times with their operating income. If you're using Simply Wall Street and you need to know the definition, you could just hover over. Interest coverage ratio indicates ability to service debt using operating income. Higher interest coverage implies lower default risk. You want this number to at least be 2. If it's below 1.5, and if it's below 1, there's major concern. In 2012, they had $5.4 billion of debt, $18 billion of equity. Both their debt and equity have increased over the years. Now they have $13 billion of debt, $29 billion of equity. It is good to see their equity is higher than their debt each year. Most people that invest in this company do so for the dividend yield, which is 6.1%. Since they have negative earnings, they have a negative payout ratio, which is not good. So this is something you want to check each quarter to make sure their earnings can eventually cover their dividend. Because if they can't get to that point, they will have to cut their dividend. They do raise their dividend each year. They were paying $1.10 in 2012. and it rises each year. The forecast is for them to pay $2 by 2025. They're currently paying almost $2. And the yield has been going up a lot. It was 3% in 2012. But the reason the yield is going up is because their stock price is going down. As the stock price goes down, the yield goes up. And as the stock price goes up, the yield goes down. I wouldn't be shocked if they cut their dividend in half, so it's 3% again. The CEO's salary is $1.5 million, total compensation $18 million. The CEO, Roz Brewer, has been with the company 2.3 years, and she is not doing a good job. Since she's been there, the stock has gone down dramatically, and they're not growing anymore. In the past 12 months, there's been one insider buy, the CEO, and a sell. The CEO paid $34 for the stock. If you buy the stock today for $29, you get a better deal than the CEO. 60% of the company is held by institutions, 23% by the general public, and 17% by private companies. Their biggest shareholder is NewSip. They own 17% of the company. Then Vanguard, BlackRock, State Street, Capital Research, Geode, Fidelity, Invesco, Wells Fargo, Federated Hermes, Northern Trust, UBS, Morgan Stanley, BNY Mellon, Camber, Legal & General, ProShare, Schwab, LSV, Amundi, Dimensional Fund, Eaton Vance, First Trust, Goldman Sachs, Antipodes. They did have 206,000 employees in 2012. It was up to 370,000 in 2015. Now they have 263,000 employees. The ticker trades on the NASDAQ since 1968. Deutsche Börse, Mexican Bolsa, Zicha, London Stock Exchange, Wiener Börse, Euro TLX, the BATS Europe, Sao Paulo Bolsa, and Buenos Aires Stock Exchange. So I hope you liked the video content. Like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.